everyone, and welcome back to the PetroNerds podcast. This is episode 58. My name is Trisha Curtis. I am the CEO of PetroNerds and the host of the PetroNerds podcast. And this episode was recorded actually on August 11th. So today it's September 1st, and I'm going to recap you a bit on the market because we've had a wild ride since August 11th to September 1st and what's going on in the oil market. And I have given a slug of presentations here in Denver and virtually as well. But this presentation that you're about to listen to, or this talk that I gave, was done on August 11, 2022. My nieces were with me. It was awesome. I gave it with the Denver Petroleum Club. It was the lunch program for their mentors. So it was Denver Petroleum Club Mentor Program. And at the time of recording, or on August 11th, oil prices were $93.51 for WTI. We had nat gas around $8.35, and we were seeing Dutch TTF at $62.54. Now, a lot has changed since then because as of August, we've seen since then, just recently, we saw $100 Dutch TTF prices. We have seen oil prices push toward 100 and come back down. Now we're seeing prices at $87 and change. We're seeing Brent at 93.50. 93.30. And so oil prices we saw Brent just the other day at well over $100. So we're seeing a lot of movement in oil prices. We've heard the OPEC. We heard the Saudi oil minister actually talk about, after I gave the speech a couple of weeks, we've heard the Saudi oil minister talk about actually doing cuts, or saying that they would be willing to cut production because they didn't think the market was being reflective of actual oil prices and fundamentals. And we also have Iran, the Iran sanction, or the Iran deal, or potential lifting of sanctions on Iran impacting and weighing on oil prices. Fears that if these sanctions were lifted, the oil prices would come back down. And we cannot leave out the Fed. So I'll get into describing what this presentation is, or talk that I gave is, in just a second. But since this presentation, August 11th, we had the Fed speak in Jackson Hole last week. So last Friday, the Fed spoke, and it was a pretty big deal because the Fed's hawkish tone and these worries about a deal with Iran are and recession concerns and real worries about demand are weighing on oil prices. In addition to, there is some credence to be given to what the Saudi oil minister said, of that we do have some erratic trading. So we have a lot of algorithmic trading. We have less physical human traders in the market, and that we can see pretty exacerbated moves. So we're moving $10-15 in a 2-week period on oil. That should tell us something. But the hawkish Fed is also weighing on oil prices, because the dollar is surging, and we are seeing a lot. When dollar surges, you should have an inverse relationship with oil. So what's happening is that Fed came out, Jerome Powell came out and had some very hawkish comments with regards to inflation and fighting inflation. We saw another person from the Federal Open Market Committee talked yesterday about how they're very bullish on Fed rate hikes. Right? They expect the Fed to hike over 4%, and they do not expect the Fed to lower rates in the course of 2023, which is completely different from what the stock market was baking in this Fed pivot, that the Fed would see a recession, that inflation would come down, and the Fed would have to lower interest rates. And that's clearly not what the Fed is signaling, not what was signaled at all in the 8-minute speech that Jerome Powell gave in Jackson Hole, Wyoming, which was that he was concerned about inflation and that the Fed needed to learn from history and understand history from the 1970s and fight inflation and not let it continue to go up and then bring interest rates back down and then continue to fight inflation. So that has a lot to do with the Fed's credibility. A year ago in Jackson Hole, Jerome Powell was talking about inflation being transitory. Clearly, it has not been transitory, and now this is what they're fighting. And this really does have impacts on the overall economy, on recession worries, on risk, and obviously on oil prices and potentially on oil demand. So in this talk that I give to some industry leaders in the room, as well as the mentors or mentees that they had with the Denver Petroleum Club, we cover everything in this talk, which I really encourage you to listen. There is 100 slides that go with it, but the talk works great for a podcast. And my nieces were kind enough to sort of help me out with recording, so the audio is actually pretty good. And I talk a little bit slower in this presentation, so I think you folks will enjoy it. But I cover everything from the global oil market in the beginning, the macro economy, U.S. inflation, oil prices, oil demand. We talk about Chinese coal production, Chinese unemployment and housing. We definitely get into ESG and sort of framing that, and also talk about U.S. energy production, the drop in U.S. energy production during COVID, during 2020, what happened with coal, oil, and natural gas across states, and really get into U.S. oil and gas, the U.S. oil and gas production, and the split between the publics and privates, and what's really driving the move there for public-private investment. Now, I'll talk about this in future podcasts and definitely have this teed up to talk about the Fed and what's going on with the current energy crisis in Europe and seeing $100 it's since come down, but Dutch GTF prices did hit $100 in dollars per MMBTU. So huge surge in prices. We are seeing absolute serious fears and concerns for inflation it's dooming, it's pending, it's looming in Europe, because we are seeing 9.1% inflation in Europe, which is at record highs, and we're expected to see teens double-digit inflation in the UK very soon. Several banks are calling for a recession by the fourth quarter for the UK of this year. And I think that's really important to point out in the context that we have California. So we have California right now. California came out and said they're banning internal combustion engine cars, so ICE engines, by 2035. And we also had just recently, just like within the last couple of days, the governor Gavin Newsom come out and say that they are concerned about rolling blackouts potentially in California, given issues with energy. And because of that, they're going to lift waivers and bans, and they're going to lift the amount available that the power plants can burn natural gas. So if we've learned nothing from this crisis in Europe, I think really it is energy security, how critical and how important it is, and the fact that we are having grid instability and reliability in places like Texas and California, and absolutely on the East Coast, where you need more natural gas and you have to have these reliable backups included. And California has had to import a lot of that natural gas and a lot of that into their grid, so we are going to see continued issues with that. And lastly, just to recap, there's a lot going on in China. So we are seeing the city of Chengdu, a city of 21 million people, not nearly as, Shanghai shut down with 25 million people for 2 months for COVID. Chengdu is in lockdown right now. That is 21 million people. It is not nearly as economically important to the country of China as Shanghai. However, it is a major manufacturing hub. So iPhones are produced there, or components of iPhones. We are seeing a lot of autos are manufactured there. A lot of auto parts are manufactured there. We're talking Volkswagen, Toyota, things like that. And if you saw auto data today, we actually saw that there was a real, the average car or auto price is about $46,000. And the average new vehicle lease or payment is over $700 for the American consumer. So huge amount for a new vehicle, which is another inflationary issue we can talk about. But the point is that there's not enough autos out there, and there's not enough cars to actually be sold, and that is impacting auto manufacturers. So a shutdown in China like this is a big deal. We are seeing we're seeing a lot of data coming out of China in terms of poor manufacturing data because of COVID lockdowns, and we're seeing major issues with regards to across the world, as we're seeing with regards to lack of hydropower, because of not enough rain and because of a very hot summer, and because China's grid is 17% hydropower, 17-20% hydropower, significantly higher in certain areas. That is really cumbersome, and so you're seeing massive brownouts and blackouts and problems with energy security within China. And I have to point that out because within the context of this presentation, I say that China has power security, and they have enough on a nameplate capacity in terms of how much coal they produce and how much coal they consume for power. They do have enough. But that being said, because they do have renewables and because they do have hydropower in their grid, when you have a very hot summer, you draw down on you draw down on everything else, and it can create dislocations across their economy and across their electricity grid. So with that, I'll leave you guys. Thank you so much for listening. I really hope you enjoyed this talk and presentation, and talk to you soon, folks. Bye. Okay, so I'm titling this False Sense of Security. And the reason that is because I think that there's a lot of things in the market. If you watch the stock market, or if you're just looking at oil prices today, I do think there's a false sense of security in the market. And part of that's because oil prices are up. I think the economy looks pretty bad. Yesterday, we saw the inflation rate come down to 8.5%, but that doesn't really reflect reality, given that the only thing that drove down inflation was actually oil prices, and everything else is up. And there's massive, extreme, unprecedented geopolitical and economic complexities taking place in the market. If you don't know PetroNerds or what PetroNerds is, this is a PetroNerd. That would be me. On top of some tank batteries. My dad was pumping wells several years ago, and I was out there. So I love the business. I'm third generation oil and gas. My dad pumped oil wells. My grandfather pumped oil wells in Wyoming. And I was very fortunate enough to go to college and work in the business on analyzing the crap out of it, and explaining it back to people and helping people understand it. If you haven't listened to the podcast, I absolutely encourage you to do so. The last several are really good. Heidi Gill was a guest on my podcast. I have several guests talk about the market. My nieces even listen to it. We talk about inflation a lot. So major takeaways.
And I was given some loose terms on this. I was told to talk for like 40 minutes, so we can plow through things fast. You can, if there's certain things we don't want to cover or skip over, that's totally fine. But major takeaways: unprecedented complexities, which I'm sure that will be a takeaway in this as we go through this. Recession and potential crises, and really not potential, more like actual crises. World War II analogies. There are many of them, and I'm not trying to be alarming. They're really serious, and that's part of the crises thing. We probably have more World War II analogies or more, upcoming to war analogies than we ever had. Understanding risk and sort of appreciating it, and China, because we cannot not talk about China, because it's me. The current crisis. So these unprecedented complexities. Rampant inflation. This inflation was happening, we have war and more inflation. So we already had inflation well before the war in Ukraine. That war in Ukraine was teed up for a long time, basically since 2014, really, since Russia invaded Crimea. But actually, it was really teed up, I think, more so from mid-last year, mid-2021 to now. And so that's been taking place for a while. But even before that, we also had inflation, particularly in the US. We actually led the world in inflation with a lot of stimulus and a lot of spending. So we now have food and energy crises because of the war and because of lots of things going on. We have a very severe anti-oil and gas movement, ESG investor pressure, and aggressive green policies. And those connected together have really helped exacerbate a lot of the problems we see here. So food and energy crisis is absolutely, it's very, very serious for the bottom sort of 50% of the world, and really impacting folks that we're seeing in Africa and the Middle East. Even Middle Eastern countries that produce a lot of energy are really being severely impacted with energy crises and with food crises. And the 27 trillion global economic stimulus, so about 27 trillion was spent between fiscal and monetary stimulus during COVID. A ridiculous, unprecedented, insane amount of money that was pushed into the global economy that screwed it all up. And a good amount of this was fiscal stimulus from our Fed and others, and then very long lags in responding to inflation. And now we have big problems. So we have these severe fiscal lags leading to employment latency, not paying student loans, massive increasing food stamps by a third, not having to pay rent for 2 years. There's a lot of fiscal lags in the system that are helping. It's helping, I wouldn't say incentivize, but it is a component of people not going back to work. When you have 2 job openings for every 1 applicant, that's a big problem, and that's part of it. Part of the recent, last few weeks, but the price spike that we saw previous to that is really about reduced refining capacity and reduced oil and natural gas. The oil and natural gas production we've had for a while, the reduction, but this reduced refining capacity is pretty serious. That happened during COVID again, another lag, and that's part of also the severe anti-oil and gas movement. The war in Ukraine, provoked by the second largest oil and gas producer in the world, supported by obviously the number 1 importer, China. And what are business leaders thinking, and are they prepared? I know that they're thinking about this, but whether or not they're completely prepared, there's so many things happening right now. And this is not just oil and gas leaders that have to understand. This is every business. This is CEOs of Tesla, this is Ford, this is Caterpillar. I don't know if you saw Lowe's and Home Depot today. Lots of things that are super interconnected that really matter for business and absolutely matter for oil demand and oil and your guys' business. So the backdrop: health of the global economy, OPEC, Russian production. We're going to go through this fast. This will give you a nice snapshot on what the global economy looks like. So that's oil and gas prices and the economy. And I really think it's important. This is 2007, 2008 that I've put here, right? So we have this price spike. There was a lot of things happening. Obviously, we had a subprime mortgage meltdown that took down the economy, but we also had inflation, and we also had oil prices. And we're nearing those sort of levels over here. And those gas prices, I would say, are way more important than oil prices in many ways, because we can sort of eat oil prices to a large degree, but gas prices are embedded in the economy in a way that really impacts the ability for you to heat your home, the ability for you to cool your home, and the ability for to turn on your lights and your electricity. And that's a big deal and something we're really, really seeing in the inflation data right now. Now, obviously, our prices are not nearly as high as Europe, which is a very big problem and a serious energy crisis, because it's not even going to be about prices, although that's very serious, and we'll talk about that. It's whether they're going to even have enough gas to use it. So the reason prices are up is because they don't have enough gas. And the curtailing on gas consumption, and I know Chris Wright and Liberty talk a ton about this, about ESG and poverty, but it's a really big deal because in Europe right now, I mean, Spain has instituted curbs on, right now, it's very, very hot in Europe, and they have a cap on air conditioning to 80 degrees. So that is the highest you can lower your cooling at 80 degrees. Can't really cool off anywhere. And then this winter, the highest you can heat your home is going to be 66 degrees. And that's going to be a problem, I think, for a lot of people and a lot of businesses. So we've had a bit of erratic prices, obviously, in nat gas. That was the Freeport LNG facility that went out here that curbed that. Obviously, our prices are up because we do reflect the global market a bit, and we're exporting about 12 BCF a day. And then European gas prices, though, are back to all-time highs of $62 an MCF, which is just absolutely insane. And it's going to, I mean, I 100% believe, I mean, Europe is already in recession, but they're going to pull the global economy into recession. And wait till this winter because things are about to get much, much more messy over there. So oil price volatility, I do think it's really important to thinking about oil price volatility, because when you listen to earnings calls and you hear CEOs and everyone talk about the macro and what the forward curve and the strip is, and everybody feels great, that's the strip from June 27th. It's nice and clean and pretty, and oil prices don't usually look that clean and pretty. They kind of look like that. It's a little bit, it's messy. And this is sort of that false sense of security. We're at $93 a day. We were $87 last week. I saw $86 at one point. So you can see it's pretty erratic. This decline that you've seen in oil prices in the last week or two is about demand. And that's really serious, because that's something that I do think some oil executives, there's a bit of a disconnect in where people really think we have a very healthy macro. We do not have a healthy macro. The macro looks awful. The global economy looks horrible. And every time everybody's declining gross domestic product, economic forecasts, and that means GDP is highly correlated to oil demand. So oil demand will lag, just like employment will lag. But it's really serious to think about that, because it's not as rosy as it looks. It's more about a supply tight picture. And even then, I'm not quite as concerned about supply as most people, although we did draw down a lot on our crude inventories in the US, which is problematic. And it's kind of nice to think also about just the past on where we were for these oil price chunks. So that red line is oil production. We're climbing our way back to pre-COVID levels. It's taking a bit of time, but we're going to get there. But prices, if you just bucket this up to 2000, 2007, our prices are at $44 on average for that time. Then we moved to $88 in 2008, 2013, and averaged $58 between 2014 and 2021 altogether. That should tell you a lot about people thinking this new price environment of 100 forever. I just call BS on it. It's just not. If you're comfortable with 100 forever, this is just not the oil market that we live in, because yes, there's unprecedented volatility that could certainly drive prices higher, absolutely. But there's also supply, and supply comes online when prices are this high. So you can't see this, I apologize, it's a little small, didn't know what my screen would look like. But we saw inflation data come out yesterday. We've seen the Biden administration and many others really brag that inflation has come down. Look, it went from 9.1% last month to 8.5% this month. The problem is the only negatives that you see. So when we talk about inflation, it is a serious deal. I mean, it is a tax on the consumer. It is a major, major deal that a lot of people don't appreciate. That's all energy, that we're seeing. That's the only negative we had. We had oil prices drop in the past month, and that's what drove down prices. And the reason oil prices dropped was because the price is so high, and between inflation and high oil prices, we curtailed our demand a bit. And then all items, less food and energy, those all went up. So food is just out of control. And I have two nieces this week, and grocery shopping has made me scared. Going out to eat is scary. Like, everything is like, holy crap, bacon is $16 for 12 pieces. And it's a little bit, we're in Bananaville territory. Cereal is at all-time highs. I mean, actually, if you look at food, we are at levels that literally levels we've never seen before in prices. So very, very big deal there. So inflation has not only came down in energy. It coming down at all is good, but actually food, shelter, everything, or shelter and food have really gone up. And then add the payroll and jobs report. So the podcast that'll come out this week with Gabby, that I did with Gabby, we talk about this, and it's great, is that the jobs report that came out last week, if you've watched the stock market and you've seen the 10-year yield, or you've just seen people very bullish on the stocks are going back up, and it's great, and the 10-year yield is coming down, and mortgage rates are coming down, and that 10-year yield tracks its mortgage rates really well. But our jobs report was great. that's not good for the stock market, because that means the Fed is going to see this as this is bullish, right? We're adding jobs, and but we have high inflation, and so that means you've got to raise rates. You have to raise rates, and they're just been very slow off the mark to do it. So we added a bunch of jobs, more than double than expected. We have a decline for the second month in a row of labor participation, and we have a 5.2% increase in average hourly earnings. That is a major problem, because wage price spirals, when prices go up and wages go up, it gets entrenched in people's minds of inflation, and that consumer expectations for inflation. Very, very big deal, because when that gets entrenched, you can't rewind it, and then the Fed and your labor market, which people think is so great now, doesn't last, and it just deteriorates because no one can afford it. And that's why the Fed has to raise rates, is because the labor market will be way worse in the future if they don't do it now. Now, we also have a global economic, this is from the World Bank. It was a great report, but I mean, they call it a global commodity shock without parallel. And it really is, because it's all these factors of inflation and energy and food all coming together at once. Something we've never actually seen before. You can go back to the 70s. Yes, we had high oil prices, but the inflation came down pretty rapidly, as did oil prices. Now we have high energy prices, and we have high everything prices. And so energy price growth, several 100%, we're up nearly 400%. Fertilizer price growth is 200%. Food price growth is up that's probably 100% now. And the problem is obviously, fertilizer, we need natural gas to make fertilizer. Natural gas it's extremely important. So that really rapid cost, we're seeing for natural gas in Europe and elsewhere is really impacting fertilizer prices. Countries, African countries and Middle Eastern countries and European countries aren't able to pay for that fertilizer, and therefore their crop yields are down. Obviously, Russia and Ukraine export a lot of grain. So it's just a very compounded, interrelated problem that is very, very serious. And I think it's going to make the Arab Spring and sort of the 2010 time look like kittens and daisies and unicorns, because this is much, much more serious. And people when you put these economic problems on people, they do riot, they do revolt, they do protest. We are seeing, and the World War II analogies are, Sri Lanka has had massive protests. Pakistan, Italy is without a leader, so Mario Draghi has bowed out. Boris Johnson has bowed out in the UK. And Neville Chamberlain did the same thing. You have multiple leaders in Europe that don't exist right now, countries without leadership right now, and you have a war in Europe. Not a great time to not have good leadership when you have this going on, and then all these economic complexities. And then the China thing we haven't even talked about, which is serious and also completely funding the war in Ukraine. So this is a complex and compounded food and energy crisis. The IMF and the UN has some great stuff on this. So between fertilizers, food, crude, nat gas, maritime trade, the cost of just actually moving stuff, that's gone way, way up. And so all these compound together, and rising interest rates to really create problems for the global economic system to move around. And that rising interest rates, is not just, it's a big deal, can be a big deal for the oil and gas industry. The ability to borrow, you got to refinance your debt, things like that. But that goes for everyone. So particularly in tech, that's why tech stocks really get hammered when interest rates go up. So tech, Tesla, Peloton, you name these companies that sort of need this money. And then green tech, really, really big for wind, solar. This all has to be subsidized, and part of why they did so well, especially during COVID, this green technology, is because of very low interest rates. And when interest rates go up, they don't look very attractive. They weren't economic to begin with. They're not economic now. They probably won't be economic. Some would wager never, but who knows? I'm not going to poo-poo them all day long. If they're made here and we drop the cost, I'll be all for it. Russia and Ukraine export more than just oil and gas. So you can see, this is the colors you probably can't see very well on the screen, but that's Russia and Ukraine in red. Obviously, the percent exports they send to these countries. A lot of these countries you can see are in the Middle East or in Africa. So these are the vulnerable countries that are heavily exposed. So when they're not getting food and fuel, that's a problem. And then you can see that metals and minerals, they export a lot of metals and minerals, and that impacts the entire global supply chain for everything. Same for not just energy, but pig iron. That's huge, as you know, in this business. Steel, iron, all this stuff is really having an impact on the global economy. So debt vulnerabilities, a lot of people have talked about, this is not the same as 2008. We don't have a mortgage crisis. We don't have sovereign debt issues. We actually do have sovereign debt issues. So lots of these countries, African, European countries included, many countries have issues with debt levels. And so we see the sovereign bond yields are above 10% in nearly a third of the emerging market economies. So emerging markets are not doing well. They actually weren't doing well previously, but it was okay when energy prices and inflation wasn't going out of control, and now it is. And then when we have rising interest rates and we raise interest rates and everybody's pegged to the dollar, they have to do that too. And that's really troublesome for them. And then everything's priced in dollars. They can't afford it, and it's a mess. We also have food protectionism. So a lot of people trying to like curb, canola oil exports or things like that. And so that food protectionism just keeps the food in their countries. That's creating problems. That creates dislocations and supply chain issues across the globe. And then moving into Russian gas dependence. I mean, the darkest colors here, this is Europe. The darkest colors here in red are the most dependent upon Russian gas. And you can see, obviously, Germany is one of those countries. So that's a really big deal. And it's a really big deal for a number of reasons. And this is this is sort of, if you take nothing away from this presentation, please take this slide away. And this EIA does a great job. Every day they put out these awesome little nerdy charts. But this one's fantastic because this crystallizes the energy crisis we're seeing in Europe and the incredible green aggressive policy agenda that was just bad policy making. And this is domestic production. This like maroon bar here is UK and European domestic gas production. Okay, so we can see from 2010 to 2020, it has just come down considerably. That is UK and European domestic, or their actual consumption. So consumption really hasn't changed, has not declined. So obviously their imports have to increase considerably. So their vulnerabilities and their geopolitical security here, their energy security, it just continues to dwindle. And then 2020 really exacerbated this because there was an ability to there was a big ESG movement, obviously in 2020 with COVID. People were able to sort of latch on to the idea that, look, this is what the world could look like, so we can reduce all this production. And Europe absolutely did. Not only did they have COVID restrictions because of people going on offshore rigs, they weren't actually going on offshore rigs, so they dropped their production in the North Sea, in the UK, in Norway, et cetera. They all dropped their production. But then, in addition to that dropping of production, they also didn't invest. They don't have storage. So when their storage is essentially their production offshore. And when that production drops, and then you have maintenance issues and everything, it just compounded to be a very, very big problem. And we saw that actually last fall. So the last spike we had in oil prices last fall when prices went to $80 a barrel, that was really because of the energy crisis. That was the UK, Europe, and China all demanding a bunch of natural gas because they had a really hot summer and a cold spring in Europe, and they did a lot of fuel switching. So they switched their natural gas powered turbines, they switched that over to diesel, and we spiked demand by about 1 million barrels a day for oil demand that wasn't expected, and that's what drove that first price spike. But we also had an unprecedented amount of renewables come online in Europe, particularly in the UK. They were at an all-time high of renewable power generation capacity in September 2021, and they had an all-time low of renewable power output from renewables in September 21 because they didn't have enough wind, and they didn't have enough sun, and they didn't have enough rain for hydro. And then they were drawing down on their natural gas. They didn't have it, and they didn't have their coal either because nobody likes coal anymore, and coal it's becoming very attractive right now because it's energy security. I mean, you can shovel up coal, you can put it next to you, you can shovel it into your power plant, you don't have to pipe it, you can put it on a truck, you can put it on a rail car, you can put it on a ship. It's very easy to move around. We have a ton of it in the US, they have a ton of it in China. It's energy security, and I think I can guarantee you that we will use more coal now than the projections for coal use are going to be way, way higher in the future than we are projecting simply because of everything I'm explaining to you. But this is Russian pipeline flows of natural gas to Europe, and they've cratered. So this is why we've seen these massive gas price spikes. And I really don't think our stock market, nor many people in business, really appreciating how damning this is going to be to Europe and how damning this is going to be to the world and the global economy. So we can see these flows have really just cratered to nothing. Germany have come down considerably. So Russia had that Nord Stream 1 pipeline was flowing. Russia said, hey, we gotta do some maintenance on this. They did some maintenance on this pipeline, and then they brought the pipeline back to 40% of capacity, and then they dropped it a few days later to 20% capacity, and then they're just kind of holding still and just doing a lot of threats. I mean, it's low. It kind of ebbs and flows in how much they output, but Europe does not have enough natural gas, and they have not invested in storage because they don't like fossil fuels, which I don't even call fossil fuels. I call them crude oil, natural gas, and coal, but they don't like natural gas, so they haven't invested in storage, and they don't have it, and that's a very big problem. Now, the U.S., as you know, we produce sorry.
Can we ask questions while you're going? I'm sorry.
No, you absolutely can.
Just because of the Russia piece in particular. why are those supplies dropping off in Russia?
So I'm about to get to the Russian supplies, not so much for natural gas, but we'll come to that. And I think that's a critical component of sort of is Russia going to continue to produce and export, or are they going to reduce their production, and then are we going to have a problem? And that's also a big deal on the oil side of, can oil prices maintain their elevation? That's huge. So if you hold that, and if I don't, answer it perfectly, just interrupt me again, and we'll make sure we do it. So this is U.S. natural. Obviously, we're exporting above capacity, or we're about 12 BCF a day is what we're exporting. Huge amount. We export more than anyone in the entire world. We produce more natural gas than anyone in the entire world. Our gross withdrawals are about 120 billion cubic feet per day. We're the largest oil and natural gas producer in the world. I have to say that and emphasize a lot because you don't hear it on BBC, you don't hear it on Bloomberg, you don't hear it on CNBC, and you sure as hell don't hear it out of the White House. We are the largest producer of oil and natural gas in the entire world. And if we built a pipeline from the Marcellus to the Gulf Coast and we exported more natural gas, we could drop our prices, but we could absolutely solve the European problem because we have the natural gas. It is not a problem. I mean, this is a small molecule. It's easy to produce. We frack the crap out of it, and we're barely Liberty just entered the Haynesville. We barely sort of really pushed the envelope of the Haynesville. People have really curbed their work in the Marcellus because they don't have a pipeline in the nearing capacity. So the natural gas side, I'm extremely, in our ability to produce in the U.S., I'm not concerned about it from a technical standpoint. Lots of logistic issues, lots of inflation and employment issues. So that's our pipeline exports in gray of nat gas, and then our exports in red, and you can see the ratchet up in BCF a day. That's 12 BCF a day on average that we've ratcheted up in exports. That's huge. If the world didn't have that 12 BCF a day, it would be a lot more painful than it is. If we look at just demand, what people are thinking, this is OPEC and IEA, and even OPEC is pretty bullish. The one thing I would say, everyone, when you're thinking about Saudi Arabia and you're thinking about OPEC Plus, you think about OPEC, you have to realize OPEC is very good about, and OPEC really is Saudi Arabia, but they're really good at supply. They are not very good at demand. They're not really good at sort of assessing demand and moving around really quickly. They're not known for that. The reason we have oil price volatility is because they aren't that good. They've managed to sort of, doing this 2020 onward, they've sort of managed through this pretty well with this OPEC Plus agreement. But even they are saying there are significant downside risks stemming from ongoing geopolitical tensions. They don't call it the war in Ukraine. They call it a skirmish or an invasion, or geopolitical tensions. The continued pandemic, rising inflation, aggravated supply chain issues, high sovereign debt levels in many regions, and expected monetary tightening by central banks in the US, UK, Japan, Eurozone. So a laundry list of things that could impact demand, but they're pretty bullish. And then the IEA, the International Energy Agency, says that rarely have we seen an outlook for oil markets this uncertain. And I think that uncertainty is something people really have to appreciate, is that if you just look at IEA, so International Energy Agency in red, EIA, that's our government agency, Energy Information Administration, and then OPEC, that's your demand outlook. And you can see, obviously, they're kind of in line, but then they blow out a bit in 2023. So the point is, we're going to get this wrong. As forecasters, we will get this wrong. It's pretty hard to predict, but they're not quite in line, and they kind of go all over the place. Switching back gears really quickly on refining, we lost over 1 million barrels a day refining capacity in the U.S. So that big run-up we've seen in prices, obviously, we saw $140 a barrel for a minute with the war in Ukraine. We have probably now at least $25 to $30 of geopolitical tensions that's in oil prices, which should really make you think a bit, because if oil prices are $90, $30 of that could be geopolitical tensions, which means supply and demand, where should we really be for oil prices is something that people have to think about. But we lost about 1 million barrels a day of refining capacity in the U.S. That is really serious. That was COVID, that was lack of demand, lots of things, but that was definitely ESG pressure as well, and investor pressure, and just curtailing, oil, wanting to curtail oil and gas consumption. A lot of this was in California. They have pushed really hard on regulations going against oil and gas. So that's that black line where we've declined refining capacity. That red line is our gross inputs into refineries, and you can see obviously drops way down during COVID, comes back, but hasn't come back to pre-COVID levels, and so that's holding back the refined output. So that's a big reason why we had such high oil prices, is because we didn't have the refining capacity. And refined product, your gasoline, your diesel, the amount we get at the refinery has that impacts oil prices a lot. And so Singapore, Rotterdam in the Netherlands, and the Gulf Coast are sort of those major refining centers that help set the oil price, and this is part of it. And then this is your just percentage of operable capacity. We're not running at flat out at 100%. We're running close. We've really ratcheted up. And so this has helped. You've heard Exxon and Chevron say they're bringing back capacity. This is a great slide from Exxon. And they just show the net loss, but they show the total cumulative loss for US, Europe, Asia, and other. It's over 3 million barrels a day of lost global refining capacity. That's huge. That's one of the single biggest drivers right now in high oil prices is the lack of refining capacity. And it's when you have refining capacity and then it's off somewhere, you just decrease your refined exports, everybody's got to adjust and the flows have to move. And that's part of why prices are high. That's Saudi oil production output in red in 2022, you can see. So they're pushing north of 10.5 million barrels per day. UAE crude production is pushing 3.2 million barrels per day. Saudi oil output, Biden went over to the Middle East and he went to Saudi Arabia and he talked about, I don't want to say necessarily he begged, but he might have asked them for increased output, as the administration has asked them a number of times, but he finally went over there. They came back and said, the Saudis said, yes, we're going to increase output. The Saudis came back and said, no, we did not say we're going to increase output. We will increase output as planned. With our trajectory through 2027, we'll be adding 13 million barrels a day. I do believe they are doing that. We are seeing the investment. Saudi Arabia is increasing. It's behoove them to do so. They're doing it. But we can see this output. They're actually going to have their record high output annual. So they'll be on an annualized basis, on average, they'll be producing north of 10 million barrels per day for 2022. That's a big deal. Again, we're way above that, but that's still a really big deal. And what's really interesting is Saudi Arabia burns about 1 million barrels a day of crude oil in the summertime for their power plants. So they burn their diesel, they burn it. Right now, it's so nerdy. They're buying Russian fuel oil at a discount. So massive discount, and they're burning that instead, and then they're exporting all their oil. So makes perfect sense for them. You swap, it's really nice. Works out great. This is the rig count for Saudi, UAE, Oman, Iraq. The only thing I want to point out here is that's the Saudi rig count. Obviously, it has not come back to pre-COVID levels, but their output is. The output's coming back. So that's something to keep in mind, of that rig count does not track perfectly in line with the output. I mean, it does roughly, but we're not near at those levels, and we're over 10 million barrels per day. So that part of that fuel oil piece that I just said is part of that. That's OPEC output. We're nearing about 29 million barrels per day. This is Russian price discount to Brent. So it peaked about at minus $37 a barrel, and it's hanging around over $30 a barrel. So if you're buying Russian crude, you are getting a severe discount to Brent. So India is buying over 1 million barrels per day. China's buying 2 million barrels a day. This is a big deal. And to your question, Russian exports. So this is Russian crude oil exports. We've actually seen them be pretty well maintained, the crude oil exports. We've seen the Russian oil product exports decline. So we've seen the refined product exports decline. And there's a number of things going on there of, will a country in war with their economy declining, will they maintain their crude oil output? Will they maintain the refined product output? And will they maintain the exports? And that, I would love to say yes, they just will, because this matters a lot to them and they need to export it to maintain stability economically. China is paying boatloads of money to them from grain to coal to natural gas to everything. But you can, when you're doing war and you have instability, this is a big deal. So if and they may be doing it intentionally, but we could see production fall off a little bit. That may not matter because demand might fall off a little bit as well, but it's something very, very important to watch closely. We have not seen their pipeline crude exports to Europe drop at all. Those have been maintained, nor has Europe said they don't want it, so they've been buying the crude. It's really all about natural gas right now. And I don't think it's about natural gas production declining. I think it's literally it's how they're using it as a weapon. But I'm not concerned at the moment about Russian natural gas production dropping off a cliff. That's Chinese crude oil imports. And so China imports over 10 million barrels a day. And the main takeaway here, I cleaned this up and the titles are screwed up, so I apologize. But they import 1.5 million barrels a day from Iran. A country that says they're not exporting, they don't say they're importing that, but they're getting 1.5 million barrels a day from Iran. They get 2 million barrels a day from Russia. They get 2 million barrels a day from Saudi Arabia. So quickly you can do the math. Those are countries that we don't really like. They're very favorable to China. So China has not security supply perfectly. They still goes through the water. They've still got seaborne issues, but they have a they're friends with the countries that aren't very, pretty autocratic and not friendly, but they're getting the crude from them. They don't import a lot of natural gas, which is why, because they don't want that geopolitical vulnerability. That's India's imports of Russian crude oil. So you can see it's jumped up dramatically. Italy is actually importing about 500,000 barrels a day of Russian crude oil as well. That discount is just super appetizing to people, so they're taking it. That's Russian output. So it actually, I think there were some projections. There was a month where it declined. It's kind of come back. And that did shock the market a little bit. So Russian output has been relatively maintained for oil. And that's why I say we have to just watch it super closely of how well maintained is this going to be. And I would say their economy declining, they're going to be consuming a lot less. So that's something to think about. And I'm going to burn through these really fast because we're not talking too much and not making great time. Okay, consumer sentiment is very bad. We're this is Michigan Consumer Sentiment Index, absolutely horrible. If you look at this from 62 to now, we are lower than we were in the 70s for consumer sentiment. So when people say we're not in a recession or things are great, I call complete BS on it. It's just not true. A definition of a technical recession, I literally pulled out my college textbooks last night. It can range from 2 consecutive quarters of negative economic growth or 2 consecutive quarters of slower economic growth. That is 2 consecutive quarters of slower economic growth. That is 2 consecutive quarters of negative GDP growth in the US. That is a technical recession. That's the definition of recession, which I could care less because I really care about the Walmart earnings call and the Target earnings call and how badly those consumers are doing, and they are in recession. So the administration or officials or Janet Yellen used to be she was the head of the Federal Reserve, but she doesn't think, she knows better because she was the head of the Federal Reserve, so she has a PhD in economics. That's a recession. So saying it's not is just, it's absolutely ridiculous. So something's happening, right? Something's happening in the US economy. But if you watch the stock market, you wouldn't necessarily see that. So you have to really, see what's happening between food prices and fuel prices. And that's the biggest story. But US and GDP, US and global GDP contractions are a really big deal because this means that global demand for oil will decline. And we are seeing the IMF, every quarter, the IMF declines their GDP forecasted, economic growth output for the world. They did it that was from April, and they said that, we were 5.7% for the US, and they keep declining that. We went from globally being at 3.6% next year to going to 3.2% to 2.9%. I'm sure they will downgrade this again. So that's not great. And I think that's going to continue to decline. And obviously some countries will be negative. The Walmart and Target story, their recent earnings call was also a bloodbath for Walmart, but the previous ones, it was all about inflation. It was they had a lot of stimulus. They didn't forecast well that the stimulus checks would roll off and that people would stop spending. So people spent like crazy with their stimulus money, and then that ended. And I think the brutality was inflation, and that was that they hit it on the fuel side, so they were hit really high on transporting stuff. And then they built up all this inventory because we didn't have enough inventory, and then nobody bought the stuff. And so they have to discount all their products. And then the recent earnings call was really, really more scary because they said we've never seen food inflation like this. And the problem is that all the consumers at Walmart are basically buying largely food. And so food is a thinner margin business, and people are actually, we're hearing in Europe, in the UK, where people are just putting all the groceries on the, they call it the till, but on the cash register, and they're just saying, give me 40 pounds worth, and they stop at 40 pounds and they put the rest of the groceries back, because that's what people are at. It is a super, super serious issue, and I absolutely don't think people are appreciating the health of the consumer on the bottom 50% of America is just getting shredded right now, and let alone savings. Credit card spending is going way up, but everybody's blowing through their savings and putting stuff on credit cards because that's your inflation levers have dropped a smidgen, but that's food inflation is 13.1%. That is absolutely out of control, and we're at levels that we've never seen it before. And so it's just biting into everybody's ability to do day-to-day things. Electricity prices are up 15%, and you can see that's July. Those are just by the kilowatt hour. Electricity prices are also brutal. So this winter, people are going to have to decide between, heating the home, paying the rent, and that's another big problem, and paying the mortgage and feeding their kids. And the debt problem is also really big. We were $16 trillion in debt, household debt. We added $1 trillion in debt in last year, in 2021. That is the single biggest increase we've seen since 2007. Yes, that should make you think about 2008 and the recession and the big problems there. But we've added even more recently. So we have over $16 trillion in household debt. A massive amount of this is obviously from housing debt, from mortgages, because everybody and their dog wanted to buy a home during COVID, and we all needed vacation homes, we all needed to renovate our home, and we needed new kitchens, and we needed patios, and we needed everything. We didn't actually need any of that, but that's what we all wanted to do. And we all pulled out debt on our homes, our equity, and because it was cheap, and we built all this stuff. That helped, that helped Lowe's, and that helped Home Depot, and that helped all these businesses and everything. Also created massive supply chain bottlenecks, made it very difficult for the person who needed the washer and dryer and didn't need an upgrade to actually buy it, and it created all this price inflation and labor issues and everything. And now people bought, I truly believe people bought homes that they couldn't afford. And then we also have this other debt. Now, we haven't paid back student loans in 3 years, so that's a problem. So mortgage rates are going up. That's a problem as well, because it's expensive to buy a home. The housing index does not look good. Like the sentiment on housing, if you walk around Denver, if you walk around Highlands, you will see a lot of new homes being built. And the Fed, Jerome Powell actually mentioned that in his last speech, of the homes there's a lot of new homes coming online, and they're coming on in a softer market. So new home builds are a very big deal because we have a ton of them coming online. Rent is very expensive, so yes, people still want to buy, but they don't want to buy they may want to buy, but they may not be able to afford it given all the other things we've just explained. UK inflation, electricity prices, that's UK inflation. That's just out of control. And their electricity prices have quadrupled in 1 year, and they just raised electricity, the price cap, to £500 per month, which is, if you can imagine if our electricity bills were $500 a month, it would hurt pretty bad. Even for people who can afford it, it would still hurt, and it's really hurting the average person, but that's something that's just, I think, going to really tank the economy in Europe. And then inflation, that's that blue chart. Inflation is out of control in Europe as well. And those electricity prices, those are rough, and they're all going to curtail gas demand. They're all going to curtail gas usage, particularly in the industrial sector. And if you curtail gas usage, that's going to curtail your output of goods and services, which means you have to slow the economy. And that's really not being reflected in most data. So all this inflation, the Fed has to raise rates, and most people would say that most economists are projecting unemployment will rise. The trouble we're having with people appreciating that unemployment rises, it lags. This is home prices. We're backing, I don't have these slides in order, my apologies. That's average home price in the US. You can see that on a tear. Average mortgage size. Just important to point out that in 2007, 2008, the average home price was a lot lower than it is now, and the average mortgage size was a couple $100,000. Now it's double that. So yes, the mortgage rates are lower. Healthier consumers, I still think it's a big problem because those mortgage payments are a lot higher. So inflation, interest rates, and unemployment, this is your other money slide that if you take nothing away, stare at this one. Because if we think about, you see inflation in orange, you see unemployment in purple, and you see the Fed's fund rate or interest rates in black. And what you'll see is that the orange and the black they kind of track together. They're not really tracking together now. We're off kilter. If you have a zoom in, we're off kilter where we've allowed inflation to go up and the Fed funds rate has really lagged behind it. Unemployment comes after you raise rates and you have inflation. And so you can see the 1980s, May 1980, you had 14.7% inflation. January 1981, you had a 19.1% interest rate. And then November 1982, you had 10.1% unemployment. So guarantees are really hard, but I would bet a lot of money that unemployment is going to go up and it lags a bit. So if we look at high oil prices and high inflation, we've never seen it before at these levels. That's oil prices in green, inflation in red, and that's the 1970s where you had high oil prices, but then inflation, the oil prices came up, but not to those levels, and inflation then came down, and we've had low. And that low oil prices, low inflation, we had that. We actually had great unemployment too, and we don't have that now, and that is extremely damning to the future outlook for the employment side. And that's why the Fed is so anxious right now, because they were behind the curve. Global oil demand, you can just see over time, this is just historical oil demand, how it dipped. That was a 6 million barrel a day decline in the 70s after 2 oil price shocks. East Asian crisis, very little, and then we lost about 1.4 million barrels a day of global oil demand in the Great Recession. The thing is, in the Great Recession, we were the ones that dropped the oil demand, the US was. And we consume about 20 million barrels a day. So we move the needle a lot on the global oil market and oil prices. And that's a 3.7 million barrel a day decline in the 1980s. It took a long time to recover. We did not recover that demand until 1998, and then we lost 2.5 million barrels a day demand in 2008 with the Great Recession. Unemployment lagged there too. Another nerdy chart. Never seen anyone put this together, but I couldn't help myself. This is U.S. home prices and oil demand, and they rise. This is just for the U.S. And they rise and fall together. That's 2008, that's oil demand and housing prices, and literally track in lockstep. And that's because you're using diesel, all these components, like the economy is rip-roaring, and then it slows down. And I'm not saying they're going to crater by any means, but they will come down together. And that's just US GDP, that's GDP, global GDP, unemployment, and oil demand. And you can see they also track really, really nicely together. I'm going to probably pause here and say we can take questions because I didn't get through all my slides, but that's okay. This is the remember to be humble slide, and that saying I will be wrong. Most forecasters will be wrong, and that's because we always take the moment we have in time where we're sitting and where oil prices are at, where our crises are, and we use that to sort of project forward. And this is a slide from 2000, and you can see the high oil prices. The Energy Information Administration said the high oil price in the year 2000 was going to be under $30 a barrel, and we were going to be about $20 a barrel. And the problem is that when you go back and you look at all these forecasts from the IEA, from OPEC, and from EIA, what they get wrong is that they basically got wrong oil prices in forecasting, and they got wrong oil demand. So and oil output. And they always thought that oil output would be lower, the lower the oil price, and that wasn't true. We had very low oil prices in the US, and we still produced a lot of oil. And they also tend to get demand wrong. But the output and oil price are really critical. And we've got those wrong basically historically every single time. US demand, you can see that that red line is US demand, and that black line is oil prices. And we have come off, we peaked demand sort of in December of last year for oil demand, and it has sort of backslid, which has got people a little bit anxious. Nothing crazy, but it's come down a bit. This is the joint statement from Russia and Ukraine, from Russia and China that came out on February 4th. If you haven't read it, I absolutely encourage you to do so. It's an incredible document. And when people say there's no limits to the friendship, it actually said there are no forbidden areas of cooperation, which is very, very serious because Russia basically had this huge agreement with China. China's funding this war. And the reason why this is more serious, because I really do believe this is sort of the battle before the bigger stuff that's happening. I mean, this is a little thing not a little thing, it's very serious, but it's going on in Europe. It's not affecting us the same way it's affecting everyone else. But China has got the eyes on this as opposed to what's going on in China. Not as of late because of the Taiwan stuff, but this is really serious because they both reaffirmed their support for each other, especially their territorial ambitions. Chinese raw coal production is at all-time highs. They've increased output by 100 million tons in the past 5 years alone. They have domestic energy security. They have domestic power security through their own coal production. Really serious, because they're the only country in the world that's actually building out renewables with their coal power generation in tandem. And renewables helps them, they build up the sector, they sell it to us, and then they put their renewables in with the coal so they never have intermittency issues. They're also facing huge costs for the transmission build out in renewables, so that's probably going to slow. But that coal output should make people a little bit nervous because food and energy security has been a really big deal in China, but coal output like that means that you really want domestic energy security because you may want to go do things in the waters, and you may want people you've kind of secured your oil from Saudi Arabia and Iran and other countries, and yes, we could screw up the waters, the sea lanes of communication, but they can turn the lights on, and that's a very big deal if you want to go to war, or if you want to just take over Taiwan, or if you just want to make sure your territorial issues. Energy security is extremely important. And this is China imports from Russia, just so you can see in dollars. So you can see that it's high. So obviously it's gone up considerably since 2020 alone, but it really has grown in the war. So a lot of Chinese money is going into Russia. And I'm sorry, that's coal output again. This is Chinese unemployment. We have a big deal with Chinese unemployment. Their economy is not doing well, and their housing sector is an absolute mess. So you've heard of Evergrande, probably Country Garden, this sovereign, these debt crises with the home builders. It's about a third of their economy. So it's a huge deal, and it's extremely, it's falling apart at the seams. You now have people not paying their mortgages, and they basically, the way they fund their housing sector is you're paying a mortgage before something's ever built. So you put a down payment, and it's a bit of a Ponzi scheme. It's kind of a pyramid scheme. So you're the builder, you're the home buyer, and you pay him. He hasn't built it yet, but you pay him, and then you continue to make mortgage payments. But now you're looking at these houses never being built, and you're getting worried that you may never get it. So now you actually have people squatting in very unsafe, completely unbuilt homes without electricity, just 20 people living in an apartment. And it's extremely serious. That could also take down the global economy. That's a big deal. But they're trying to insulate their economy in many ways because they do have territorial ambitions. That's home price decline. You can just see that it's continuing, so that's a problem. This is, we'll switch gears into ESG, and this is how we'll close. So ESG, investor pressure, policies, regulations, This is a power plant in Hayden, Colorado that they're going to shut down, which I'm pretty bitter about because Xcel has very ambitious plans to reduce their carbon footprint, which is going to reduce it by very, very little. But they want to shut down these coal-fired power plants. And the relevant point is this is the engine number one. This is the forecast from engine number one that they used to get on the board of Exxon. And this was their oil demand trajectory. And basically the whole synopsis was, hey, look how erratic oil demand is. And we're not going to demand oil anymore, and therefore, Exxon, you need to let us on the board, and we need to help you not curtail oil production because we're not going to demand it. And therefore, you won't be profitable if you're producing oil and we don't demand it. That's just clearly not, that's a real problem with that thesis. But the real big problem is that if you're investing in renewables aggressively as an E&P, you're not investing in oil and gas. So there's dollars going to renewable energy that does not produce as high of a BTU, as high of an energy output. And that is creating and exacerbating the current food and energy crisis. And that is, to me, a real ESG problem. And it is a moral problem, and it's very serious, and it drives me absolutely insane. So when Exxon, and they're doing a little bit better now in how they're talking about it, but they all bent the knee, and they all went crazy, and they all dove into the ESG pressure. They're going to be spending in 2025, they'll be spending $3 billion of capex on renewables. So very, very lower BTU outputs, though, because think about if that was going to oil and gas. And then the percentage, basically, of these companies spending, all these big, oil and gas majors and national oil companies, the push to them to, the percentage of the capex to go to lower carbon, it's very big. Now, we have these SEC proposed rules on climate change. This would impact their Scope 3 emissions. This is mentioned 344 times. This would impact way more than just oil and gas. This would impact the entire U.S. economy because this is your end user emissions, which is impossible to deal with. And the real problem I have is that when oil companies say, okay, well, we're okay with Scope 1 and Scope 2 emissions, but we're not okay with Scope 3. And they've leaned in way too much to the ESG side. And they have to be, and Chris Wright had an amazing quote in his earnings call, and y'all should listen to it. I put it on LinkedIn. I posted it on LinkedIn. I put it in my last podcast and the last couple, actually. But he just says that, look, the industry, if we aren't going to talk about what we do, then who else is? If we're not going to talk and advocate about what we do, there is nobody else that's going to do it for us because they don't like this industry. And so it's really important that the oil and gas leaders talk about how serious this is. And I say, if you give a mouse a cookie, they're going to want a glass of milk. So you can lean in all you want in Scope 1 and Scope 2, and I respect reducing methane emissions. We're doing all the good things that we can do. But you have to explain that end user emissions completely screw up the economy. And this is the I Heart Net Zero, is every single company is all about net zero. What is net zero? Net zero is net zero emissions by 2050. Net zero came from, this is independence, oil independence in the US, Exxon, you name it, everybody's all about net zero, which is, it's fine. But the reality is that US oil and gas production only contributes 1% of US CO2 emissions. So you can reduce it, you can kill yourself all day long, and you are not going to drop, you're not going to impact CO2 emissions. So then it's hard for me to understand that it's about CO2 and it's not, this isn't something bigger. And if it's not actually benefiting anything, you're spending a lot of money on it. And the problem is when you give a mouse a cookie, they want a glass of milk. This is where if you listen to shareholders' board meeting call, if you listen to Exxon's shareholder calls and other major, their calls that they let you listen to, the people that call in and say, hey, we should do this, they reference this. And this is the World Benchmarking Alliance, which tells oil companies not to a certain percentage, a little bit they want to spend on green. They want them to limit their capex to only 23% of their capex can go to oil and gas production in E&P, which means that energy crisis we're talking about now would absolutely explode because only 23% of E&P capex can actually go to oil and gas, and the rest 77% needs to go to low carbon and renewables. And that's a problem. That's all meanwhile, China's ramping up coal and telling us they're doing their net zero, which they're not doing their net zero. They're just saying they're going to do the net zero. Since this whole thing with Taiwan has happened, they've decided that they're not going to talk to us about climate change anymore. That's super shocking because they were never serious about it in the first place. So we all should have shocked faces on right now, which, wow. But their wind and solar additions, they have massive amounts, and that's because what I said, they're building those out in tandem. But another big ESG problem I have with this is that all the wind and solar that we're buying, almost all of the world's global solar panels, we're talking 80% of, we're talking batteries, solar panels, heat pumps, majority of them are coming from China. So in 2020, we're talking about nearly 80% of batteries are coming from China. And we're talking about over 70%, and it's actually higher in 2020. We're talking about 80% of solar panels are coming from China. And so when they're sort of causing the problem and selling the solution. Say they're the largest CO2 emitter in the world, and they produce those solar panels with coal-fired power generation, with their domestic coal, with forced labor in the province of Xinjiang, and then they sell it to us, and we have all these aggressive policies, and we put it on our roofs and everything. And I know that makes people feel better, but if it's not necessarily solving anything, especially in the beginning of that. And they've been able to drop prices considerably because they sold the tech. I mean, this is 100% factual, by the way. They sold the tech, the best solar panel technology. They stole it from Germany. Then they started producing it in the province of Xinjiang with forced labor, so they were able to drop the cost dramatically because they don't pay people to do it. And then they exported it all over the world. And they are absolutely involved in pushing the climate change green rhetoric to help do this. And it's a really significant issue. The propaganda piece is not really appreciated. But you can see for copper, lithium, nickel, cobalt, rare earths, they control a vast majority of it. And that's a problem when we're not in good relations with them. They do have 3 million Uyghur Muslims in forced labor and internment camps. This is their newspaper, by the way. So this is Global Times. It's one of their big geopolitical ones that they want Americans to see. And obviously Nancy Pelosi's all over it. But this one's big because this is one they came out with a couple days ago. This is their 9-dash line. And they basically said, quote, not even a bit of left behind. So they've been wanting to go after Taiwan for a long time. But now I think it's really serious to appreciate that they are at the height of their economic economy. They're not going to have a better time to do this than now when global leaders are falling off the cliff. They absolutely view the US as very vulnerable. They don't see the leadership strong. They talk about in this newspaper a lot about Biden being a much older man, that he has health issues. So they see it that way. The other side of this ESG thing is that the estimates are extremely expensive. And I just explained to you how good the global economy looks, which is not great. And the estimates for the energy transition is 9.2 trillion a year between now and 2050. So I have no idea where that's going to come from. It is a massive amount of money. We don't have it anymore, and that's 276 trillion. And when you do the estimates or back of the envelope stuff on actually what the mitigation efforts for the fires that are taking place in Europe right now and everything, the mitigation efforts are significantly less. So there's a push-pull of sort of understanding what to do and what not to do, and these numbers are just bananaville. And so it just won't happen. Whether people want it to or not, it's just not going to be paid for. And lastly, I'll close on the US because I'm very bullish on the US technical side, but I think the public-private split in the US is very, very significant. That's purple are the public or private rigs. Orange is public, and you can obviously see that publics have not come back. And that, to me, that's obviously investor pressure. That's not just ESG, but that's a component to it where the publics have not come back in earnest in producing oil and gas. They're giving a lot of money to shareholders, and rightfully so. I respect a lot of reasons behind that, but there's other things. We lost a record amount of energy production in the US in terms of BTU output, and this is just a great chart the EIA just put out, and it's a huge amount of coal production in Wyoming. This is super serious from an energy security standpoint, and something the opposite, again, of what China is doing, and this is how you flip the game in terms of geopolitics. If you wanted to take all the power away from Russia and China, you would produce as much oil, natural gas, and coal in democratic countries in the US and Europe as possible, and they just wouldn't have the power and control in that. And that's exactly what China is doing right now, is producing as much as they can so they can have the greatest geopolitical flexibility. And it's a pretty bipartisan issue, the China thing. That's US production. Gas production, we talked about that, highs. New Mexico is producing 1.5 million barrels per day. That's just huge. That's Texas on top, New Mexico on the bottom there. So that's Permian and obviously Eagle Ford. The crude output has come back significantly. You guys know this, you're in the business. You know how tight everything is. But New Mexico output, that's 2 counties. That's Lee and Eddy County. This is some of the best rock in the entire world, but it's good. So I'm not worried about our wells sucking or what it looks like. I mean, they're not. We don't have as many. We're about to where we were for the previous rig count, so we've sort of crushed that, especially with efficiency gains. That's oil rigs, that's gas rigs, and you can see for oil rigs we have far more privates than we do publics. And on the gas side, we haven't even come back near where we were, and we're producing a crap ton of gas from that associated gas. If you normalize all these basins, Bakken, Powder, DJ, Anadarko, Permian, Eagle Ford, on a normalized decline curve, they've still increasing productivity, even by, it's a smidgen, it's a tiny, but the fact that they've increased productivity all is significant. That's your cum, that's not normalized. But the reality is that we haven't lost massive diminishing marginal returns. Our average lateral length is, we're kind of flattened out a little bit, but we're still under 10,000 feet. That's Permian Basin average lateral length is well over 10,000 feet, really crushing it there. That's your Permian public-private rig count. You can just see, I mean, privates are going crazy. Publics have not come back at all. That's Permian public-private rigs here on the left. That is your DUCs. And I think it's really important to see that is that privates are sort of everywhere. And it really debunks the tier 1, tier 2, tier 3, tier 4 acreage thesis. Because when oil prices are high and these privates clearly have the funding, they've been able to get the funding, they are drilling everywhere and they're poking holes in the ground. And eventually those holes being poked in the ground come back into production. But it's also meaningful because it means that the theses that privates couldn't get capital, they have gotten capital. And they also, if you talk to a lot of privates, they are pretty aggressive in how they're completing these wells. They're not they're not curtailing their completion design or anything because they want the maximum output. And that's significant because it means a lot of sort of the technical stuff that people thought was over is not over. And I promise I'm almost done. This is your Permian public-private rig count, which to me really illustrates the impact of investor pressure and partly of that ESG and that investor pressure. And that's your publics, which have just not come back, and that's your privates. Your privates, we have more private operators and private rigs now than we did pre-COVID. And you could talk to many major private equity firms, the heads of private equity firms, and they would have told you a few years ago that was not possible. They said that 1 and 2 rig companies in the Permian would go away, that trend was dying, and we completely debunked that. And again, this goes back to my will be wrong thesis. That's your public and private rigs. Again, you can see where the privates are, where the publics are, they're very concentrated. The privates are everywhere. I mean, this is a good thing, they're de-risking stuff. That's your horizontal well completions. That's horizontal wells brought online. So we clearly have not come back to pre-COVID levels, and yet, we're getting there. And that's just that split. Private wells have come back, publics have not. Again, that's that pressure, which is really serious. And I'll close just with DJ. If you have a lot of publics, you won't have that movement in terms of your wells being added. And we have a lot of publics here. We have some privates. That's your well completions, and that's your permits. And with that, I will close. And thank you so much for your time.